What if I told you that investing in stocks works exactly like pouring a cold beer? Sounds ridiculous, but in the next few minutes, you'll understand the stock market in a way that almost no one talks about. And it will actually make you money. Every single day, millions of investors stare at red and green numbers, obsessing over prices that go up and down for reasons that feel completely random. But beneath all that noise, there's something far more powerful: the actual value of the business underneath. Today, I'm going to show you how to separate the two, using one of the most powerful and overlooked analogies in all of investing. Picture a glass of beer. That thick, frothy head on top? That's the foam. It looks exciting, it's dramatic, but it's temporary. In the stock market, foam represents everything emotional: fear, greed, hype cycles, Reddit threads, CNBC headlines, and pure speculation pushing prices around every single day. The liquid below? That's the beer, the real stuff. It's built on a company's actual revenues, profit margins, brand strength, and competitive advantages, things that don't evaporate overnight. Here's the problem. Stocks aren't poured into a clear glass. They're poured into an opaque mug, like this. You can't easily see how much is real beer versus empty foam. And that confusion? It costs investors billions every single year. In fact, research consistently shows that roughly 70% of active day traders lose money over the long run, largely because they're chasing foam. The total stock price you see? It's always beer plus foam. Always. The greatest investors in history, the people like Warren Buffett, built their fortunes by focusing almost entirely on beer-heavy companies. Businesses with durable advantages, strong brands, and reliable earnings that compound year after year. Think Apple, Coca-Cola, American Express. Buffett's strategy was ruthlessly simple. Buy when the foam is low and the price is less than what the beer is actually worth. Buy $1 of value for 50 cents. In today's market, those deep discounts are rare, but finding solid companies trading at a fair price is still very achievable, and it's still how wealth gets built. Now contrast that with foam-dominated stocks. In January 2021, GameStop surged over 1,700% in a matter of weeks. Pure foam. Driven by social media hype, not business fundamentals. Within months, the foam evaporated, and investors who bought at the peak lost 90% of their money. Foam can make you feel rich very fast. It can also wipe you out even faster. When you shift your focus from foam to beer, everything about how you invest changes. Instead of refreshing your brokerage app 30 times a day, you're asking better questions. Does this company have real earnings? Is the business growing? Is management allocating capital wisely? And here's a stat that should stop you in your tracks. Research from JP Morgan found that if you miss just the 10 best trading days in the S&P 500 over the past 20 years, your returns would be cut nearly in half. The 10 best days, out of 7,300 total trading days. And those 10 days most often occurred during periods of extreme fear, exactly when foam chasers were panic selling. The people who stayed invested in real businesses, they captured all of it. So next time you look at a stock, any stock, ask yourself one question. How much of this price is beer and how much is foam? Anchor yourself to fundamentals. Pay a fair price. Stay patient through the noise. That's not the flashy strategy you see on TikTok, but it's the one that has built more generational wealth than any other approach in history. If this changed how you see the market, even slightly, hit that like button and subscribe.